So I'm here with David Mercer, CEO of LMAX Group. David, welcome. Interesting times in markets, we'll get to that in a second. I wanted to start off by talking about your recent figures that were released. You're looking at sort of gross revenues just shy of $60 billion, 90% up. I think your gross profit was 27% higher. EBITDA, which I can never remember what it stands for, but you can explain it to me if you need to, plus 30%. Your volume's 15% higher. Crypto off the scale, 14 times higher. It's a little bit of a unique story. I mean, you're looking very happy at the moment for those numbers, but it's a bit of a unique story in the industry at the moment in terms of platforms and exchange providers.
Sure.
What's behind it?
I think the main thing is the diversity of our business model. So first of all, yes, we were very pleased with it. Although I'm never that pleased, you can go out and talk to the guys on the floor.
As it should be.
If we're 20% growth, I want to tell them we should hit 30. But the reality is, look, I have a diversified business model. That means if there's a lot of volatility, I do well on trading commissions. Mm-hmm. If there's low volatility, I do well in financing and clients holding positions. So the unique positioning we have is that we operate an institutional exchange model. I also have a regulated broker in the UK, a regulated broker in Cyprus, a regulated broker in Asia Pacific. So it's yin and yang in terms of how those work together. Likewise, unlike a lot of the other, say, institutional only venues, I have what I like to say is all market segment access. So the whole spectrum of people, firms who trade FX can trade on LMAX exchange today. If you go to the ECNs, what you call the primary venues, I call the legacy venues, they're all basically fishing for the same 100 clients.
Yeah.
To be fair, I'm also fishing for those 100 clients, but I have a much wider distribution model. And I think that's why you see the differentiation, the growth in our revenues, but at the same time, we need to grow the last number there, which is the ADV, which is our total volumes.
Yeah. So, I mean, do you notice different behaviours from different client segments or user segments across different market conditions?
100%. So it's what we're seeing with central limit order book liquidity is our biggest growth area has been the banking segment. We've onboarded quite a few of the top algo desks in the last 18 months. So what we're seeing now is a lot of activity from them over the hourly fixes. And then not much maybe in the other hours of the day, which is a bit frustrating. Whereas a retail broker client, it's pretty consistent. Of course, you get the normal peaks over news releases, economic events, but I'm not seeing these spikes from the banks, which I guess is coming from the real money segment. I see big spikes and heavy trading, heavy volumes in particular currency pairs over the fixes.
So, does that make your challenge then trying to even that institutional volume out a little? Or, I mean, obviously, ideally you want to double your fixing revenue turnover and then bring the rest of it up with it. But what's the challenge behind getting that consistent?
We're always trying to find a balance. So maybe we'll never get there. I like to think we're a fast growth business. As we add takers, as we increase our volumes, the mix changes, and my liquidity providers see it as a different business. So what generally happens is I onboard a big client, that's an extra yard a day, we're all very happy, the LP goes, something's changed here, they widen out, I lose a yard and a half. So it's getting the balance, and I'll be frank with you, the first 4 or 5 years of LMAX Group's existence, the open door that we pushed at was the retail broker segment.
Yeah.
And that was typically softer flow, easier to placate or onboard new liquidity providers. Over time, we're almost saturated there, and that everyone knows us, and we do well, and we compete. It's competitive space. Over time, we onboarded proprietary trading firm flow and bank flow, and naturally, that's quicker and bigger. It's not even so much that it's sharp and you have all that toxicity chat. It's just that it's bigger. Over a fix, you'll see a bank with me buying a few $100 million over 5 minutes, and that's just a different flow to manage. So the reason my liquidity team used to be one bloke, you know him well, it's now 5 people globally, and it's 24, 5.5. So just a constant challenge. I think anyone that runs an exchange group or a venue business has to keep an eye on that. If I set it and forget it, we'll go backwards.
Yeah. Obviously, you don't want to be going backwards. So what do you think the keys are to continuing those impressive numbers? There may inevitably be a slowdown in trajectory. These things happen, it's a cycle. But what do you think are the keys to the LMAX Group business to maintain momentum?
So I think with increased diversity, so what have we done? I have 3 business lines, clear business lines within the group. Back in the day, I had 1.
Right.
So the LMAX Group has LMAX Global. That's a broker business. I have LMAX Exchange. That's a venue institutional business. I have LMAX Digital, which is obviously a crypto business. So crypto, I'm not going to tell you that we were particularly forward-looking. We launched it. I had no idea how it would go. Typically, within our group, it takes 3 years to get to sort of break even and to see whether an exchange is going to work.
Okay.
This was our 5th exchange. It broke even in month 5, right? And not a massive number, but of those revenues that you were looking at, nearly $60 million in gross revenue, 7 million of it came from crypto in year 1. That was crazy. I couldn't have expected that. So I have that lever to pull. Institutional volumes more than doubled last year. So that's not a high revenue business for us. You know how little banks and non-banks want to pay. But that's a new revenue stream for us. The broker business was challenged because across the globe, regulators limited leverage. So that affected a lot of my primary customers. And what I saw from them actually was that they traded less, but they held more positions. So suddenly the balance sheet provision, the clearing for those brokers became more valuable. So we've got to keep that diversity going. We need to do better in Asia Pacific, right? That's very obvious. So geographically, I need to do better in Asia Pacific. I need to do better in the Americas. So NY4 last year was only 15% of our volumes. Q1 this year, knock on wood, I have to just do that. Q1 this year was 30%. And you talked about big volumes last Friday. In New York, we printed 8 yards, which was a record for New York. In a global group number that was 36 yards. So geographically, Asia, Americas, and continue to diversify our product. I'm not going to tell you anything this year, but at some stage we're going to look at other products other than spot.
Yeah. I mean, I think that's inevitable. Your point on the US is interesting because if you look at the sort of turnover data from the FX committees, the US doesn't see massive growth, and generally speaking, there are issues around the type of liquidity that's available there. So I think it's probably inevitable that you'll see some sort of slowdown there. Whereas I tend to look at it rather more positive about Asia Pacific, as I would be in base there. But in terms of Asia Pacific, what are the challenges and opportunities you see there in terms of growing your business with your current model?
Actually, Asia Pacific is really interesting. If you look at, they've always been penalised. Traders in Asia Pacific have always been penalised outside of Tokyo, because effectively the client has always paid the speed of light price, because risk books were held in London, New York, a little bit in Chicago. So ultimately, the client had to pay the latency. So you think, well, okay, what if I put a matching engine in Asia? Well, then the risk desks are saying, now I have to pay the latency price. I'm not prepared to do that. But what's happened in the last 2 years, it's pretty well publicised. The MAS have had all these incentives. You've seen risk desks move to Singapore. So it might give the proprietary trading firms, the Asia Pacific traders, a better chance, because now they can trade locally. They're not paying this 200 millisecond round trip back to London or New York. They can trade with a risk desk in Singapore. So we have we're keeping a watching brief there. We're not the first. We'll be a fast follower. The more risk desks that are there, I need a few banks, a few non-banks there. Then I can put an exchange up in 3 months and probably less than $1 million. So that's the key one, is risk desks moving out there. And then look, the age-old problem, you worked in banks, it's just distribution. The coronavirus right now is not helping, obviously, travel plans, but we need to get out there to see more clients and just keep spreading the LMAX Group word.